All right. Hello, everyone, and thank you for joining today. This virtual discussion will be going over the exam posture post-crisis. Today we have Jamie Flynn, our Director of Bank Supervision at CSBS. She's going to go through a presentation, and then we'll open up for discussion. This will be recorded for people who can't join today. This will be only shared within the state system, so no worries about us sharing it outside. So. Jamie, I'll turn it over to you.
Excellent. Thank you, Katie. So good afternoon, everyone, and welcome to this virtual discussion on the exam posture post-crisis. So today's objectives include what has been going on in the industry, expectations and responses. We'll share some agency issuances to date, and then how the state system should respond. We'll discuss examination timing and the scope, how to evaluate risk, and what examiner guidance will be necessary. So what have been the industry expectations? So first, the agencies issued the interagency statement on loan modifications that I'm sure many of you have seen. It goes through and highlights some of these main points that we wanted to bring to your attention, such as the agencies will not criticize financial institutions. The agencies will not criticize institutions that are working with their borrowers, and that agency examiners will exercise judgment. Also, the loans relative to Section 4013 with deference in that examiners will have prudent efforts to modify the terms on these loans, and that agencies do not expect to take a consumer compliance public enforcement action against any institution, provided that circumstances were related to the national emergency and that institutions made a good faith effort to support borrowers and comply with consumer protection requirements. Also, the agencies issued a interagency statement on appraisals. And there, agencies will not take enforcement action against institutions under the ECOA valuations rule for post-communication valuations performed pursuant to the agency's April 14th interim final rule, and that institutions' determination of validity of existing appraisals and evaluations used for subsequent transactions conducted during COVID emergencies are not subject to examiner criticism. So many of the statements issued thus far have been really issuing examiner judgment to in the lack of criticism. And then we wanted to highlight Section 4013 of the CARES Act, which is this relationship to deference, in that the appropriate federal banking agency of the financial institution shall defer to the determination of the financial institution to make a suspension under this section, which essentially means federal regulators would defer to the financial institutions who issued loans under this Section 4013 of the CARES Act. So what are banks saying? What are banks asking of you? We have representatives from our state processes committee, Chris Dietz of Indiana, Rashunda Kelly of Mississippi, Susanna Marshall of Arkansas, and Shauna Shields of Iowa have joined us to share their insights into what banks are saying and asking of them.
Hey, Jamie, this is Mary Beth. Before we turn it over to that group for their comments, I just would give some background. The Supervisory Processes Committee is a interagency group that meets on a quarterly basis. It's made up of representatives from the Federal Reserve, the FDIC, and as you see here, our 4 state representatives. The recent SPC meeting spent a lot of time talking about what the future of examinations look like, the risk appetites of the agencies, which is really why we reached out to Sebastian and his team to hold this virtual discussion. I thought before we jump into the input from everyone on the call, Chris, Roshunda, Susanna, Shauna, if they're on the line, they could kind of highlight what the Federal Reserve and FDIC, some comments that they heard at the recent meeting during this discussion to help jump into where states see the future of examinations, what your examiners will be doing from a risk perspective. So Chris, Roshunda, Susanna, Shauna, feel free to jump in and add any of your thoughts and comments.
Thanks, Mary Beth and Jamie. This is Chris. I guess I'll get it started off. And like Mary Beth said, we've had a lot of discussion, both internally from a state system, but also with the federal regulators about where do we go from here. Obviously, we have the challenges of being off site for a while, and that's one thing we're going to have to deal with. But also, how do we still effectively identify risk in our institutions right now? Obviously, I think the guidance put out by federal agencies is correct, and our institutions need to be able to work with borrowers, and there's a lot of borrowers that were in good shape before this, and unfortunately the health crisis has caused a financial hardship, and there'll be many that can recover as long as the institutions are willing to work with them, and I think we're cognizant of that. The question that we have, and what we've been talking about, as I'm sure everybody on the call has been talking about, is how do we still assess and identify risk during this time period, because there are going to be borrowers that'll get through this, and we shouldn't be critical of some steps taken by institutions in that time period, but there's also going to be additional risk built out of this, and there's going to be some borrowers that unfortunately aren't going to get through this, or there's going to be a longer period of repayment necessary and hardship there. So something we talked about was being cognizant, not to be critical of management maybe for doing things with borrowers, but we also have to assess credit risk throughout the process. And right now it's going to be very difficult. Obviously, the first couple of months early on is we're just gathering data. Institutions are trying to figure out what their portfolios look like. But as we get further into this, I think we're going to start to see some signs of some borrowers may be able to emerge, and some won't. And we've talked about things about how institutions shouldn't be waiting until that 6-month deferment period's over on certain borrowers, or just continuing to defer without any information. The institutions probably are going to need to risk rate their own customers, look at where the higher risks are within their portfolios, look at for certain thresholds of customers, go and look at what their capacity was before the health crisis, and see how much cushion they have, maybe from a capital standpoint, what their leverage looks like, what their earning streams looks like, and maybe stress some of those and identify those borrowers where there may be some expected stress where the repayment may be more in question than others, and then maybe try and keep tabs on those borrowers a little closer. Ask for capital and liquidity plans when we're looking at restructuring, asking about some more frequent financial statements and things like that, and just going through that process. And I think from regulators that we should probably expect a more hands-on approach for certain segments of the borrowers from our institutions, and what exactly that looks like, I think we're all learning. But those are some of the conversations we had, and I think that what's going to be really tough for us as regulators is to come across as not being critical of a bank's actions to work with borrowers, but still identifying that there is risk there, and that risk, whether a banker says, well, you can't classify this because it's related to COVID-19. Whether we call it a substandard asset, the bank calls it a substandard asset, the credit doesn't care. It's going to repay or it isn't going to repay, and that potential for loss is going to hit the bank's books no matter what we say or they say. So I think just being upfront early on, banks and us, is what the credit portfolio looks like. It is going to be a challenge for us, but something that we're going to need to try and do without overreacting too. So we've talked a lot internally about recognizing that classification levels are going to go up, indicators are going to look worse, but necessarily a 40% classified or 45% classified isn't the end of the world in institutions. And, you've got to look at what your loss exposure is like within that classification range. You got to look at migration and of credits and all sorts of other things that we all know how to do. But I think maintaining perspective too. So you can be critical of, or maybe not critical, you can identify risk without necessarily being critical of management through this process. And I think those are the discussions that we had at SPC, and I know we're having internally in Indiana and internally as a state system. So that's kind of my perspective on that, and I'm sure Rashonda and Susanna and Shauna have other comments as well.
Yeah, Chris, this is Susanna, and I completely agree and echo your comments. The one thing that I would add to that is, hold on, can everybody hear me?
Yeah, we can hear you.
Yeah, thanks. The one comment I would add is that, as many of us probably can recall, certainly here in Arkansas, we received quite a few calls early on before the guidance came out from our industry, specifically wanting some type of, if you will, a blanket approval, a complete acknowledgement that there was not going to be regulatory concern, criticism to some degree of what they would need to do in order to work with their borrowers and to help them through this period of time. And I think the guidance did to some degree address that issue and those concerns. Obviously, our banks, from what I feel here locally and across the country, are pushing forward and have continued to work with their borrowers, make modifications, extensions, deferrals as needed. And that's a good thing. And that was what we wanted and needed to do for our industry and for our economy as a whole. I think what we're looking at now, and potentially we're going to continue to hear more of, is that the banks also want a similar blanket approval or non-objection to, again, like you said, how we're going to treat these loans when we come in and the exam process fully revamps. And as time goes in the next 3, 6, 9 months, as we see how these extensions, modifications, renewals, deferments have impacted these businesses and how these loans are then going to react. And as you said, the loans are going to do what they're going to do, regardless of the regulator's perspective. But how those situations are coming back on the bank's books and how we as examiners have to then analyze that from a standpoint of whether or not, asset quality needs to be, downgraded, whether individual loans need to be risk rated differently. And our banks are kind of also wanting to know, are we not going to give more of a blanket approval or free pass on that as well? And that's going to continue, as always before, be a challenge for our examiners and how we balance that approach with identifying appropriate risk ratings and appropriate the risk profile of the bank's loan portfolio with understanding that this is a unique time and these are unique circumstances, and that it's not just a blanket pass that none of these loans will be downgraded or potential for, default. There seems to be a lot of that, again, the disconnect that's going to happen. And I think that's going to be the biggest challenge for all of us as we, revamp the exam process and see these loans come out of this forbearance period, if you will. So. I don't know, Rashonda, Shauna, if y'all have anything else, certainly you want to add to the conversation.
Well, thanks, Chris. Thanks, Suzanne. I'm not sure if Ro or Shauna are on. I think it's important.
And I was muted.
There's
go ahead, Rashonda.
No, that's Shauna.
It's Shauna.
Go, Shauna.
I don't have a lot to add. I think both Chris and Susanna summarized things well. Just to build a little bit on what Susanna is talking about, I do think we're concerned about, just kind of what messages banks have taken that at least we didn't intend to be, well, I guess we didn't issue the interagency statement, but we don't think the federal regulators intended to be the position. One way that we've talked about it a little bit is, it's for those of you that have a lot of ag in your states, this is kind of like, what do you do with carryover? And lots of times banks will ask, or think that, do you if there's carryover in a line, do you automatically classify it? And the answer is no. We look at the underpinnings of the credit. And so I think that really is kind of the answer here. It's just in this case, they might want the answer to be no, we won't classify anything. But I think the consensus of the people on the SPC call was that, yeah, we aren't looking at any kind of a holiday on classifying bank debt. I do think there might be some differences in the federal regulators in terms of their comfort level for what kind of directive they're going to hear from their higher ups. But I kind of think that was the consensus for everybody, that the risk is there and you got to assess the risk. And as Chris was saying, it's just not just a matter of, but you just have to be careful about how saying it and try to identify the risk in ways that aren't critical of management.
Great. Well, thanks to you all for sharing some of your thoughts there. I have a couple of questions I'd like to kind of ask the group in terms of first off, your sort of the message or the tone from the top of the agency and how you plan to sort of craft that message and inform your examiners who are, I was going to say, out in the field. They're not in the field. They're on the computer somewhere. But what is, has anyone gone through that exercise at this point? And you have any feedback from your examiners or how they've dealt with their bankers on that particular topic? Because it's still relatively new. It's, let's face it, 2 months ago, we were all going about our business, the old way. So just kind of curious as to what you guys have learned over the last couple of months in terms of identifying what the issues are and communicating that message to your examiners and then on to the bankers.
So this is Shauna Shields in Iowa. We're kind of in the middle of it and thinking about it, I guess, for lack of a better way of saying it. So we've shared the 2017 guidance to examiners that I think was shared as part of this call. That I think we're kind of hoping gets updated for COVID. But I think we've shared that with our staff. But our plan is to do a virtual discussion sort of like this with our staff. I think Tracy's probably on. He could probably address that a little more directly than I can. Right now, we're trying to work through some technical issues in order to get that done. But we've talked about doing virtual discussions, and we just as already on our schedule, we had a statewide meeting scheduled for June. And so we're going to be moving that to virtual, and so I'm sure we'll have that. These topics are going to get touched on during that meeting as well. So we haven't had a lot of bankers actually asking the kind of point blank, "Hey, you're not going to classify anything," so that part's good. But
okay, thanks, Shauna. Anyone else who wants to chime in on that? We have 155 attendees today, so hopefully. We have a couple of people who are willing to share their views on that.
Sebastian, this is Chris, and after this, I'll shut up. People are sick of hearing from me, I'm sure. But we've put together, actually, we're hoping that we're holding on to it until after this discussion because we were kind of hoping to get some collaborative ideas here. But we put together a document on asset quality reviews going forward, not only reviews as far as how we're going to conduct things if we can't get access to loan files. So some kind of priorities on items we want to get to look at, but also some conceptual type things about areas that we want to focus in on and areas that we think are important right now that may be a little non-traditional to what we've always done, although I think we probably should have always done them. But I think we're going to focus less on individual credit review and more on some other indicators now. So we've got a document that we hope to release to staff here in the next week or so, and we'll probably do it over a virtual discussion, something like this. So similar to what Sean is doing in Iowa.
Okay, anyone else on that topic before we move on to maybe another question?
Hey, Sebastian, this is Mary Beth.
Yeah, go ahead.
Update on the interagency statement that Shauna mentioned. So it's was issued in December 2017 after the hurricanes in Puerto Rico. It's examiner guidance on institutions affected by a major disaster. The thoughts, the agencies think it's a good starting point, and they're having discussions now whether they actually just update that to take into the considerations of a pandemic, because even though it's a major disaster, the pandemic is a little different, right? Or they're also having discussions just to issue a separate COVID-19 examiner guidance. So they are working on editing it. We hopefully will get brought in on those discussions. We've had discussions that the states are interested in being part of any issuances along these lines. And just listening to the conversations today with the Fed and FDIC, I wouldn't be surprised if they start with that statement, but a separate, instead of just updating it. I think it's going to require too many COVID-19 changes, and it'll just be a new document. As soon as we get a draft, we clearly will run it through the CSBS governance processes to ensure the states are happy and agree with the content that's in the document. But that is in the works, and I'm assuming in the next week or so, we'll get a good draft of whatever they are considering.
Okay, thanks, Mary Beth. Any comments on that? Anyone with a follow-up question?
Yeah, Mary Beth, it's Shirin Amami. Any chance that the states can participate in drafting this COVID-19 supplement to the agency?
Oh, absolutely. We voiced our request. We've asked them that we want to be a part of the drafting, not just getting the final version. So yes, Sharon, we hope to be a part of it. It kind of started out that the FDIC started drafting it, and now they wanted input from the Fed, the OCC. We've provided, where we see COVID items missing, but we have requested to be a part and have a seat at the table.
Thank you.
Yep, thank you.
Okay, anyone else?
One of the biggest challenges, as we're thinking through the issues, is really how to get updated data. Short of going to each and every institution and asking for really indicators of liquidity, capital, asset quality, et cetera, which requires obviously going to each institution, submitting, questionnaires, et cetera. Short of that, I don't know if there are sources of data that could be looked at rather than waiting for, call reports or other stuff that gets out of date very quickly because things are moving so fast. The challenge is really getting real-time data and information in order to be able to make a real solid assessment. And that's a challenge, and I don't know how to address that.
Thanks, Sharon. Actually, financial data or access to real-time data was on my list of questions for the group. Are other states out there working on getting access to more timely data, or working directly with their institutions, or maybe through their off-site monitoring or surveillance system? Does anyone have anything to share on that?
Sebastian, this is Susanna in Arkansas. So we are fortunate that we've had a program in place for over 30 years now. It's called the Self-Examination Program, and it is a month-to-month voluntary participation program that takes a condensed call report, if you will. I know that sounds like that still is a large volume of data, but it's only about 40 or 50 inputs, and it generates for us a monthly set of reports that covers all risk areas of an institution. We certainly, that program is on our website. Unfortunately, it's been, like I said, 30 years in process, and it's an electronic platform that would be hard to duplicate, but anyone on the call is welcome to go to our website or give me a shout. I'm happy to visit with you a little bit about it, or send you to someone else in our agency to talk about it. At least the program itself and the areas that we're looking at on a month-to-month basis could be helpful. So we find it invaluable, and as the banks do too. And again, as it being completely voluntary, they have certainly had a high level of participation over the years. that would be, I think, a challenge to implement something like that, here in the middle of a pandemic, especially as the banks are having to report on various other types of, requirements from maybe their federal regulator, or certainly already reporting on something at each individual state level. But that is real-time data for us. And like I said, to the degree that a state could implement something like that, I think it'd be very helpful. It's again been beneficial for us for a long time. And I know North Carolina has a similar program.
Thanks, Susanna. Anyone else on the phone right now that has anything to share on access to timely data? Okay.
I was just going to ask
Go ahead,
Sharon,
Meredith.
what is New York thinking as far as the data? Like, what data would you, if you requested it of your institutions, what would be like the top 5?
I mean, clearly earnings would be one. The risk rating of their customers' borrower base would be another one. Capital, clearly another one. Sources and levels of funding, which includes, whether there has been any significant withdrawal of deposits. Part and parcel of earnings is whether or not there has been any suspension and closing of lines of business and consumer demand. It sort of falls into the earnings category. And obviously, the number of forbearance and the fee waivers and other kinds of loan modifications they provided. I mean, it's just a whole host of stuff. But, we are sort of trying to put together a list of indicators or indicia of liquidity and solvency that we are currently considering. But again, the challenge is you don't want to overburden the banking institutions, which are smack in the middle of pandemic. They're trying to carry on with the day-to-day, and a lot of them have had, they've been participating in the PPP program, a lot of them successfully. And, there's just a lot going on. So you don't want to overburden them, but at the same time, you want to get that data. And bearing in mind, you don't want to criticize them, be critical of the decisions they've made, but at the same time, have a better picture as to their liquidity and solvency.
Yeah, I agree. I mean, the conversations with the federal agencies, they're struggling with this real-time data as well. I know some states have coordinated with the Fed and the FDIC. I know the Fed has a weekly questionnaire that they communicate and reach out to their institutions to collect this type of data. I don't know if anyone else has comments on data and how you're getting closer to, besides Arkansas, and getting monthly reporting. And I know some, like Sean, I think you were partnering with the Fed on the questionnaire.
So yeah, the Fed, the questionnaire that they've been requiring for a long time, the first go around, we didn't have any regional banking organizations or any 4 or 5 rated banks or anybody that got triggered to have to do that questionnaire with them. The more recent round where they've opened it up to do what they were describing as just a random sample of banks, of state member banks, picked up 5, the Chicago Fed identified 5 Iowa banks to have calls over. First ones were this week, then a couple more next week, and then maybe one more the third week. So they, as they were supposed to, reach out to us and invited us to participate in that, and we did. So we've been part of a couple of calls already. It's been useful information. It's just we have 252 total banks. I think that's right. And like roughly 50 of them are Fed members. So, so it's for me, it's been useful to get some of that anecdotal information by making phone calls, but we've been kind of concerned at trying to balance between bugging the banks when they're really busy with other things versus getting information. But it's been useful to at least have some anecdotal information to get a little sense of, yes, there is some loan modification and forbearance activity going on, but maybe not at the level that we thought there might have been. But it's, it's one of those things that's anecdotal. So it's, always a little bit subject to risk of, reading hope into it where there isn't or whatever, or maybe just, selection, sampling issues and things like that. But that part's been going okay. And like I said, it's been useful to just have some of that, anecdotal stuff, in the absence of having, solid data. So.
Yeah, and since the Federal Reserve has been on an exam pause, I think that's all that they've had, right? So, and they're still on an exam pause. Their senior staff are still grappling with when do we get off the pause and what does that look like? And we don't burden the institutions with examinations. So there's a lot of these discussions. And I think, when state commissioners are having discussions with the Federal Reserve and FDIC on what examinations look like, how examiners are going to criticize or not criticize, if there's a voice from a state perspective, it's very helpful. And I think, Sebastian, that's what you're trying to get to today.
Somewhat related, are there any concerns out there, or are you hearing from your examiners about obviously asset quality is declining, unemployment is up throughout the country. So in regards to the banks, the adequacy of the bank's allowance for loan and loan losses, are there any evidences out there that some banks are struggling to fund that, or to essentially make sure that that they have enough in reserve to offset any potential losses? So, oh yeah, go ahead, Kathy.
I was just going to say, since the last call, we had a conversation with one of our larger regional banks, and they are taking the position that all of these loans that they have put on deferral are TDRs, and they put in a very large provision in the first quarter. Most of the larger banks are providing. We have a couple of one-offs where they looked at their portfolio and decided that they would do a provision reversal, and it's kind of surprising. I think it's the personal opinion, not borne out by exam or facts, but I think they did it to kind of help bolster their capital because they've been growing very quickly. They're a kind of a warm de novo. And that's probably the one licensee that I'm concerned about, in that we're looking at doing our first offsite without an exam, kind of an interim downgrade on capital, because we just think that their growth in assets is, outstripping their growth in capital like 4-to-1. And the levels are just starting to get low during a time that there's so much uncertainty.
Thanks, Kathy. So Kathy is out of Los Angeles, California. Any other comments or thoughts on that in other parts of the country? Big state, small state, big banks, small banks.
Sebastian, this is Kelly.
Hi, Kelly.
From Nebraska. Nebraska has issued an examination pause, so we are in process of spinning exams back. We will be contacting institutions next week and moving forward with exams the first of the month. in our initial conversations and in expressing the fact that it's time to begin moving forward, we've had a lot of conversation about how we collect assets, how do we do a loan review. We're working predominantly, if not totally, offsite, so we're asking them to scan. At the same time, we're asking for cash flows, and the question comes down to when you're reading newspaper articles about dumping milk and you're reading newspaper articles about agricultural inefficiencies relative to packing plants closing, what is the current market value? So we're struggling with that. We're taking that back and looking at what was the line of credit prior to this event, and somewhat taking that passage in terms of, well, this too will pass. But I believe that needs to be answered on a broader issue than a single state, relative to what is a reasonable market at this time when markets are so inconsistent. I'd appreciate what the group has.
Yeah, thanks, Kelly. Does anyone have any feedback on that or initial reaction?
Yeah, this is Tim from Kansas.
Hi, Tim.
And just in the few banks that we've been in, when I look at the ALLL methodology, I don't see an adjustment on economic factors. When you look at that and you wonder, what is the right range when you look at environmental and economic factors, not just for those troubled loans, but more for the loans that are pass or, not subject to adverse classification. Certainly if they had, 0.1% before last year, there should be some kind of adjustment. The economic situation has changed, and I just don't think that they're really picking up on that. And I think that's pretty critical as we go forward. It's unknown, and certainly I think that ought to be bumped up a little bit.
Thanks, Tim. From Kansas. Anyone else on this? Adequacy of allowance for loan and lease losses. Is everyone feeling comfortable pretty much about that? Or are your examiners seeing anything that's a bit out of whack?
Ashton, there's been some chat room. So we have one from Texas regarding data. They said that we have an idea about requesting recent board packets and pulling relevant information from there to perform more current analysis. It's still a work in progress. And then we have a comment here from Tracy from Iowa. We get weekly unemployment insurance claim data from the Iowa Workforce Development website. It shows the data by county and industry, which is something our examiners can use to determine how the bank's market area has been impacted and what industries we may need to look closer at.
Okay, thanks, Katie.
Yeah, I had a question for Texas to see how they were getting those large packets. Are they using FDIC Connect or Box, or I think Texas has their own file sharing system. Is that right?
That's right, Mary Beth. We have a system that we use that was the idea, was they would just upload them to there.
So you're going to request the full packet, and then you'll do the work to work through them and find relevant information that's helpful. It sounds like, to make it easier on them.
That's the thought process. The commissioner was concerned with adding additional burden to bankers at this time, so we had thought if we just use the information they're already producing, pass it along to us, that it wouldn't create an extra level of work for them.
That makes sense. Let us know what you want to add on that.
Sure will.
I got a question that someone is asking of others regarding the Federal Reserve's exam pause. If anyone is hearing or getting word from the Fed regarding their statutory mandates, and if it's going to cause any issues with your state mandates on examinations.
This is Kathy. We've had some conversations with both the FDIC and the Federal Reserve. Internally, we've taken a position that due to the crisis, we are going to basically not be as strict or exercise more flexibility with that date. You know,
Federal agencies will exercise more. I'm sorry, would you?
No, we are, because the federal agencies have already told us that, you know, if they have an exam that's statutory next month and the Fed is on pause, they're not going to be able to do it. We're probably not going to be able to pick it up because our mandates mirror what the federal is. And so internally, since the feds have indicated some flexibility with that date, we are exercising similar flexibility. In other words, we're postponing exams that are statutorily mandated if it can't be avoided. You know, we're trying a bunch of different options before we go there.
Right.
But you know, we're if we've got an exam and nobody can do it, I mean, what are you going to do?
Yeah, I just thought state law was restricted. Does your state law give you that flexibility? I'm assuming it does. If you said you have it.
It's not really. We are using a section of law that talks about emergencies. You know, state of emergency.
Mm-hmm.
Our governor has declared a state of emergency, so it gives the commissioner some authority to make certain decisions.
Do other states have that same flexibility?
So, Mary Beth, this is Shauna in Iowa. So we have a statutory provision that we have to do that a bank or a trust company has to be examined at least every 24 months by either us or a federal regulator. The statute doesn't include a acting thing that says what happens to us if we don't do it. The problem is if you don't do it and a bank fails, it triggers tort liability for us in a different way than if we meet it. Like there was an old case in Iowa where a grain elevator failed and there was an issue about they got sued for not having examined them. And it tied to whether or not the statute required it. So if we didn't meet that 24-month schedule, we're at a higher risk of having our department be liable if there's a bank failure. That's really what the risk is. Now, we have a statutory provision that allows the superintendent to waive provisions of the banking law if necessary for an emergency. I tend to feel like it's a little problematic for the superintendent to waive a provision that gets us off the hook for liability. If the emergency lasts, we could potentially have the governor waive it. Her emergency powers, apparently in Iowa anyway, it extends to she can suspend laws. She can't make new ones, but she can suspend laws. So if we had a real problem and we had an emergency declaration in place at the time, we could maybe get her to suspend that 2-year provision. But the reality is when we hit that 2-year problem, you know, we may or may not be under an emergency proclamation at that point. So what we have going on with the Fed right now, you know, they're still in the pause mode and they don't know anything and can't tell us anything or make any commitments. What they're hearing is that one possibility might be that they suspend specialty exams. So that would be your IT, your trust, and your PSA. That puts us in a little bit of a conundrum on the trust exams because, you know, we have one independent trust company and they're not part of that, but we do a handful of trust exams jointly with them. So we have one that's scheduled. We're going to go ahead and do it by ourselves. If they get released from the pause and can join us, they will. But basically we're going to hit that 24-month deadline at the end of June if we don't go ahead and get that trust department examined. So we're a little, in terms of full bank safety and soundness exams, probably about 4 months until we run into a problem if they cease their exams, where we would have to jump in and do an exam real quick to make sure that 24-month thing is met. So it is something we're keeping track of. It's a potential issue.
Thanks, Shauna. Was someone else commenting? I thought I heard someone else's voice.
We didn't pause, New York. We continued with our examination.
So no pause. Okay. Thanks, Sharon. Any other comments on that from anyone else?
Yes, this is
Go ahead,
Matt.
Matt.
How you doing?
Good, thanks.
In Illinois, we took a short pause, but now we're sending out opening day letters. We'll probably be, one of the first exams we'll be doing is going to be maybe the 22nd, I think, of June. And again, it's going to be, and this is predominantly downstate Illinois because Chicago is a different beast, but we are going to start doing both the Chicago region and the downstate region, if you will. And I think the earliest ones we have would be around the third week of June, maybe the second week of June. And we will be doing both, or all three, I suppose I should say, safety and soundness, trust, and IT. And then for exams, again, specifically in downstate, we had some, due to staffing issues earlier in the year and staffing issues that we've had for a while, the Fed agreed to take some of our exams on some of our southern banks. And in those cases, because they're still on pause, we're going to try to take some of those back. So the key, and I think it was mentioned earlier, was try to be as flexible as possible. We are actually reaching out to the banks, already called the banks that we've targeted for exam in June to say, are you able to meet it? Do you have the staff that can respond to the opening day letters? So in a couple cases, most of the cases, they've all been very receptive to it. There's been a couple that we've had to actually maybe kick back a week to 2 weeks. Again, it's just try to be as flexible as possible. And as far as mandates are concerned and what sort of legal ramification it has, that question's still sort of being kicked around and reviewed by our governor and the legislature. So we don't have any final determination on that, but hopefully we will hear pretty quickly.
And thanks, Matt.
Yep.
Anyone else on this particular topic before we redirect? We have another item we'd love to hear your thoughts about. So as you all probably have heard, the FDIC's canceled its in-person training programs. They're transforming their core schools into virtual schools. They're hoping to roll things out in late summer, maybe early fall. And then at CSBS, we've also canceled our in-person schools and redesigning them for virtual delivery. And actually this morning we had a conversation with our team of instructors for our examiner in charge school. And one of the key learning objectives of that school is to give the attendees a sense of how to rate management, and then also assign a composite rating, and then having this dialogue with the bank, both exit meeting and board meeting. And we were kind of talking through that in this new environment of having virtual meetings with bank management, and maybe it's a different type of communication. But going back to the original objective of rating management, when obviously we know that asset quality is going to decline, earnings will decline as well. How will you, or what will be your message to your examiners when a bank ends up with a, with a 3 or 4 in asset quality and potentially earnings and liquidity, et cetera, how will you then evaluate management? Will it be on their ability to manage risk at that point in time, or will you be looking forward to and possibly look at how the bank's position could evolve? What's going to be your message on that? Basically, how do you rate management in this type of crisis when a lot of what's going on is through no fault of their own, but it doesn't change the situation and the fact that the safety and soundness of the institution may be at risk. So I'd love to hear your reaction to that.
Sebastian, this is Chris, and I think that's the key here, messaging to our institutions in a way that maybe we can all, the industry and examination force can get together on something, that there's going to be good decisions that were made on perfectly strong borrowers at one time where there's just nothing anybody could do. There's going to be classifications and losses and things that were good credit decisions and decisions that I think if you saw those financial statements, everybody would make. So I think we're going to look more towards your monitoring what you're doing to identify problems now and be realistic about those problems and try and work through what you can, rather than a classification ratio and earnings going down. Obviously, there's things that institutions could have put themselves in a position to maybe have significantly more exposure to certain industries, concentrations in certain industries that led to maybe greater impact than others. But I really think we're going to focus less on what do the numbers say from asset quality and earnings, and more so what are we doing now to identify and mitigate any problems that we have and address that, rather than just saying, well, asset quality is a 4, so obviously you've done a poor job as management, because there's going to be a number of cases where they were sound decisions and there's just nothing that could prevent it about this. So that, I think that's where we need to be from an examiner perspective, have that bedside manner when we're speaking with management about, yes, the ratings are this in these categories, and then we see significant risk in the institution, but we aren't necessarily being critical of your past actions. It's more so looking forward. So those are the conversations we're having.
Thanks, Chris. Does that resonate with most on the phone or on the line, or are other states looking at it differently?
No, I think that resonates definitely. I think that's the right approach, because you can't just simply say, well, your asset quality is 3 and 4, therefore the management should be equally rated. I think it all has to do with how they conduct their risk assessment as a threshold issue. How do you look at risk across the enterprise, and how do you manage each and every component of the risk across the enterprise? So it's really the risk management capability of the management that should be a significant factor in rating the management, in my view.
Thanks, Sharon. Anyone else on that particular topic?
This is Shannon from Washington.
Hi, Shannon.
I totally agree with what Chris and Sharon said, and I think even to go one step further, there could be a benefit to having some guidance to case managers about flexibility on enforcement actions in an institution that we feel is well managed, but they may have some asset quality problems that were not the result of poor risk selection, just more the external factors that no one saw coming. So I think that the examiner guidance that is in process will be really beneficial to the examiners in coming up with the ratings. But then if you have this situation where you have like a 2-4 split where management is still rated a 2, but the asset quality and possibly the composite are 4, then there needs to be some flexibility in the supervisory response in that enforcement action as well.
Great. Thanks, Shannon.
Yeah, this is Tim from Kansas, and I
Hey,
think,
Tim.
I'd echo what everybody else said too, but one of the things that I think is important is to make sure that they have a really robust loan review program and maybe look to expand that a little bit. Be a little bit more inclusive. Some of our loan review programs don't take a real good sample. It's pretty slim, so maybe expanding that a little bit and not looking to put an extra burden on bank management to do that, but I feel like it's pretty necessary to do it at this point with all the changes that have taken place and could result in more external loan reviews being necessary. If there is time crunch with current staff or if they're alternating staff so they don't have full staff there at all times. They may need to look more towards external loan review, but I think that's going to be critical that when you look at assessing the risk that they've done their part and taken a good look at what the current situation is and do that on an ongoing basis, not just the original underwriting.
Thanks, Tim. Anyone else on this before we wrap up? It's almost 2:00 Eastern time. We want to be respectful of your time, but we really appreciate the discussion. So we have time for one more comment. Okay.
My last comment is very helpful. Thank you.
Oh, thank you, Sharon. Appreciate your feedback. And yeah,
And
so
can I just say one more thing? Sorry. I appreciate the comments. This is helpful for us and our communications with the federal agencies. I would give a heads up. We are working on a couple of things. Clearly, the interagency statement, whatever that looks like. I think there may be some opportunity for the states to come together and maybe put some pen to paper on a potential importance of risk management type of statement from the states to industry. I think that would be a potential option right now, depending on how the interagency collaborative effort goes. We're working on a couple of fact sheets that I think may be beneficial to examiners. One on just the TDRs, the loan modifications, 4013, how those work, and just a fact sheet on the PPP, just so that examiners are aware of the program, how it worked, what the impact is to institutions. It's at no risk. They're 100% guaranteed, just so that when your examiners are looking at the loan portfolio and they see PPP, they have the information. Anything else, any other fact sheets or topics that you think would be beneficial? I know some of you mentioned documents that you're issuing today. If you're willing to share with CSBS, I think other states would get benefit out of those as well. So we would appreciate I think this is just a good opportunity to share whatever resources and tools are out there, and everyone would benefit from it.
Okay, Katie?
Yeah, thank you everyone so much for joining, and we really appreciate all the comments that everybody has made. So this recording will be sent out to everybody for you to view afterwards, as well as a feedback survey. We'd love to hear your thoughts on this virtual discussion. Thank you, everyone. Have a great day.
Thank you all.